Welcome to the Essentials of Equity Crowdfunding. My name is Anthony Millen. I'm the founder and co-chair of Next, powered by Shulman Rogers. And on behalf of Next and Jossie P. LLC, we'd like to welcome everybody here today. Before we start, just briefly wanted to talk about Next. Next is an innovative new model for the delivery of legal services for the full life cycle of a startup and emerging growth company. Next offers predictable legal fees through more than 75 fixed price packages and service bundles that have been specifically designed for the needs of startups. Next clients receive direct guidance from our senior attorneys through a high-touch, hands-on legal services model, and we integrate with a number of technology platforms to create a very collaborative, transparent, and efficient client-centric experience. We also were recognized as the Startup Emerging Growth Company Law Firm of the Year in the US this year. For more information on Next, please visit us at www.next.law. And now I'd like to hand things over to my partner and co-chair of Next, Larry Bard.
Thanks very much, Anthony. I'll start off by introducing today's panel, and then we'll get into it. We've got with us Paul Jossie. Paul is a Virginia-based lawyer and entrepreneur. His practice is focused on helping startups raise capital through equity crowdfunding and other provisions of the Jobs Act of 2012. Paul is an adjunct fellow at the Competitive Enterprise Institute, where he researches and publishes on cryptocurrencies, equity crowdfunding, and alternative and decentralized finance. Finally, Paul is the founder of thecrowdfundinglawyers.com. We also have with us Ben Maitland-Lewis. Ben is a purpose-driven founder with 2 platform exits. Ben is a Y Combinator alum who spent the last 20 years in the media, entertainment, and technology industries. Ben recently joined WeFunder as a founder in residence to help other founders raise capital and strengthen their communities. And finally, we have Gary Skolnick, who is the CEO and founder of Neighborhood Sun, a Maryland-based community solar company that brings the promise of solar to everyone, not just the select few. He has been the leader in the fight for clean energy in the region since the year 2000, either as an activist or an entrepreneur. As the leader of Neighborhood Sun, Gary focuses on maintaining the company's mission while growing the business. Gary has successfully completed a crowdfunding and also recently completed the company's first acquisition. Congratulations, Gary. We'll talk to you in a bit. Why don't we, Paul? We'll start off. We'll let people know a little bit what crowdfunding is. Maybe I'll set the stage and steal a little bit of your thunder. But if we go back, and it's always good to start a presentation talking about the Great Depression. If we go back to the early 30s and the bust in the stock market, and the federal government stepped in and said we need to regulate the offering of securities. They enacted the landmark federal securities laws, which basically said the federal government is going to look at all disclosures that where the public is involved. And then, of course, concurrent with that, they set up the private markets, but only accredited investors and venture capital firms were able to participate in that sort of private capital raising. And life went on that way, Paul, I guess, for about 80 years. And which brings us to crowdfunding, which is really the new kid on the block here when it comes to raising capital. So why don't you tell us, Paul, sort of start us off and what crowdfunding is and where it fits in the capital raising alternatives that founders have for their companies.
Sure. Thanks, Larry. And thanks to you for moderating, and thanks to Anthony and everybody at Next and the audience for being here. I'm very excited to talk about equity crowdfunding because it is new. It is the new kid on the block. It is the I believe the wave of the future and how capital is going to be, how startups are going to raise capital. At least it's going to be integrated as part of their plan. So as Larry said, for decades, after the 1933 Act was passed, the private markets were essentially cut off from everybody, but about 13% of the population who qualified as accredited investors. And those were really concentrated in a few small geographic areas, a few elite zip codes, and everyone else was kind of was boxed out of that. And equity crowdfunding changes that. And so, Larry, we can go to the next slide. So along in 2012, one of the really cool things about this was it was a completely bipartisan act signed by President Obama and led by Republicans and Democrats in Congress that passed the Jobs Act of 2012. Title III of the Jobs Act was the equity crowdfunding provision. And basically what now everyone, or at least since 2016, when the rules went live after the SEC wrote them, everyone can, with their startup, bring in private capital from the concentric circles, starting with their friends and family, then going to their ambassadors, eventually to portal lists and even marketing. But it allows everyone to invest in an early stage company and get in really on the ground floor with potentially very small minimums, maybe $100, $200, something like that. And so it is growing. It has been a huge success story so far, which we'll talk about in a minute. But that's sort of where it started. And Larry, we'll go to the next slide. So what equity crowdfunding is not, which is something when people hear crowdfunding, certainly when I started doing this in 2017, people heard crowdfunding, and equity crowdfunding or Reg CF was not what came to mind. So equity crowdfunding is not Kickstarter, Indiegogo, GoFundMe, or these other sort of platforms that you may be familiar with. These are securities. They are regulated by the Securities and Exchange Commission. And it is a very sort of complex endeavor, much more professionalized and higher level than the sort of just contract-based pre-selling a product. As
right.
you would Paul, some of these
we all have, you either watch Shark Tank, or you can sit in our conference room, and at least once a week I'll have a client say, "Oh, I just raised $200,000 in a crowdfunding," and I'm like, "What? Who was your lawyer?" Like, we didn't have a lawyer, and you're like, "What? What happened?" And they're like, "Oh no, they sold the beta version of the bed that makes itself." That's the equity, your sort of classic product crowdfunding, as opposed to what we're talking about today, which is the sale of, we call it equity crowdfunding, but it could be a convertible note or a SAFE, preferred stock, common stock, LLC interest, but some sort of investment as opposed to the product.
Right. And sort of the sad part about the Kickstarter model is some of these products actually might not even get made. But when you're investing in a company, you're investing in you are taking ownership, if you're, as you said, Larry, if you're doing equity, or you have a credit as if it's debt or some combination of the two. And equity crowdfunding is really exciting in the fact that it is open to all different kinds of securities. And I think that goes into our next slide. So you can get the issuer, or the company that is raising this capital, can sell debt, equity, or any combination of that. Now, there are obviously rules. The release that came out in 2015 from the SEC, 700 pages. So it's kind of complicated, and that's sort of why we're here to hopefully guide you through it. But you do sell securities. The securities are sold mostly through a new statutory creation called portals, but they can also be sold through traditional broker dealers. Usually not, because of the small amounts that are involved. Securities are restricted, which means they are not sort of if you're buying it on a stock market, it's instantly liquid. You have to hold them for a period of time. There are limits still for unaccredited investors. There were, up until this March of this year, also limits for accredited investors. And there are things that you have to do to get ready for that. One of the things is an accounting function. You have to have it, depending on the level that you are offering, your scrutiny, accounting level scrutiny will go up. But if you are offering, you will have to have some sort of accounting review of your company's financials. That can be a CPA report. That can be the CEO signing off on the documents. It can go all the way up to an audit, depending on how much you are offering. There's also some post-raise after you have your successful raise. There are some post compliance issues that you will have to do. And we have a representative here from WeFunder, and they do a really good job of taking care of a lot of that stuff on the back end. But you will have to do at least one post-raise report that gets filed. These are public documents. And the Form C, which is the offering document, essentially, and the subscription agreement will all get filed on the SEC's public database, which is an acronym called EDGAR. And so all of this is public. It is not like sort of the Reg D private that we were talking about in the first slide. All of this stuff is available to the public for anyone who wants to look at it. And the reports are included in that.
Paul, it's also worth noting, when we talk about the securities being restricted and you have to hold them for a period of time and then they can be sold after that, that doesn't mean that there's a place to sell them. So they're still highly illiquid, even though you're legally able to sell them. I'll say maybe once a month or once every other month, I get involved in a resale, we call it, of restricted securities, but those are almost always VC to VC, somebody, buying $15 million of a Series A round from one of the early investors. Very, very rarely. I can think of, count on one hand over the last 30 years when I've been involved in, so obviously crowdfunding hasn't been around for that long, but you could still have an employee who had a share, but somebody selling a small number of private shares. It just doesn't happen often.
That's right, and this space is really evolving. Right, we've talked about how young equity crowdfunding is, and there are sort of there are processes that are in place right now to make these shares eventually more liquid. But this is a very open space right now. Even if an unaccredited investor, say, buys a share, there are ways that you can, even within that first year, you can sell them to an accredited investor. There are sort of familial things where you can transfer them. Right. But for the most part, you are planning on holding these things for at least a year.
You might have, there are some platforms out there where private securities trade, but those are sort of for the most part, like the pre-IPO Palantir. So your unicorn type, not necessarily your crowdfunding company that's raised, $2, $3, $4, $5 million through a crowdfunding and some other instruments.
Absolutely, that's right. And I think this is one of the areas that but I do think this is one of the areas that will change coming up in the next 5 years or so. So really exciting was in late November, the SEC loosened up the rules a little bit. The SEC was extremely hostile, to be honest, about Reg CF at the beginning, but they saw that it was a success. They saw that it was gaining momentum, that there was, for the most part, a lack of fraud or underhanded things going on. And in November of 2020, they expanded the rules somewhat as part of a broader review of the private rules. And so one of those was raising the offer limit that you can offer as a startup within a 12-month period from 1.07 million to 5 million. They took off the limit for accredited investors, which had really made no sense because they are not limited in the other private exemptions. So they can now invest as much as they want, as long as they are staying in the offer limit. The unaccredited still have limits, but they were raised as well. Very, very important is you can actually discuss these raises before you file any of the paperwork. That was a major thing holding some of these crowdfundings back, because they are not how crowdfunding works is you sort of build excitement about this. You talk to people, and then this is done a lot online where hype and momentum can grow. So there are rules about that, certainly. But you can gauge interest before you actually file the paperwork. Another huge change was the special purpose vehicles. It was a very messy process when, even for very successful companies, they ended up having lots and lots of small investors on their capitalization table. The later financing, more institutional type of investors did not like that. And so one of the things that they did was allowed for all of these Reg CF investors to go into one legal bucket, one line on the cap table. Now there's lots of rules with that, but it does streamline things for the founder, and it makes it simpler for future financing rounds. And the CEO, this wasn't part of the vote that took place in November, but it was one of the things related to COVID that the SEC expanded the amount that you can offer just having the CEO certify. Honestly, I would recommend just going ahead and having the CPA do it. It's not that expensive, and you get sort of that extra layer of protection.
Right, because most founders, are passionate about their business, but they might not be passionate about accounting. That's not to say they're looking to do something wrong, but they might not sort of understand the merits and benefits of dual entry accounting and the accrual process. And I would say that every time I've ever looked at a client's financial statements that they've prepared themselves, there's always some sort of liability that I'm aware of, not even being that close to the company and saying, hey, why isn't this on there? And they'll say, oh yeah. And the next step, Paul, is, why don't we get your accountant involved?
Right. And the good thing is there is a sort of an industry of accountants who are now very familiar with the law and are familiar with what the needs are of reviewing the financial statements and what have you. So we talked about sort of how private capital was raised for decades before this law. There are trade-offs. This is, one of the good things about doing it the old way was someone was just going to write you a big check and you were done. This is more of a campaign. It can be, as I'm sure Gary will attest later, it is a long thing, it can be, and it can be, it take up a lot of your time. It takes a lot of planning. But there are lots of benefits. For instance, you broaden your investor base. You broaden the amount of people who have an economic interest in seeing you succeed, even if they're only investing a small amount. That amount can potentially turn into a lot if that company eventually registers and goes public. You can turn your customers into marketers. That's that same way that we talked about. Gathering your people, your ambassadors, the people that believe in you, the people that believe in your company. You can get all of these people on board with you. Your existing clients, your existing customers can now become investors. That puts an extra layer. That takes away a layer of space between you and them, and brings you a lot closer to the people that you are supplying a service or a product to. You incentivize these investors to again do well, because the economic incentives are aligned and everybody can row in the same direction. And when it works like that, it's really something to see, and it's really exciting. And finally, you can prove value to institutional investors who, before were, and still some of them honestly are kind of look at this and are skeptical about it. But if you show, look, hey, we have done this, we have had success through this. We now have investors in all 50 states or what have you. That shows us sort of a proof of concept that is missing when you just have one person writing you a check. So there are balances, there are trade-offs, but if you do this way, or if you do it along with some other combination of fundraising methods, it can really pay off in the long term.
Thanks, Paul. And before we're going to switch over to Ben a bit here to talk about some of the crowdfunding metrics and the nuts and bolts of offerings. But Ben, if we could just stay on this slide for a second. I mean, one of the early knocks on crowdfunding was, hey, the VC firms aren't going to want to invest in you if you've got a cap table full of, aunts and uncles, widows and orphans who have come in with crowdfunding. How what's your thoughts on that, and how has that evolved?
Yeah, I think that I'm sorry.
No, go ahead, Paul. I want to jump in on this.
I would think that there is some there is still some of that. And there probably always will be, but I think the message to the venture capitalists is like, look, this is coming. This is going to be a part of a lot of companies raising portfolios. So there's going to be some adjustment there, but the adjustment, I think, is going to at least come at least as much on the VC side.
Yeah, totally. And just jumping in here, and Paul, you did a great job on those slides. So thank you so much for walking that through. But yeah, I mean, look, at the end of the day, right? I mean, everybody's just trying to move a company forward. So whether or not you're a VC that, wants to make sure that, you've got your nice, like, carved out position on the cap table or whatnot, you want to make sure that that company has the resources to grow, succeed, and attract more customers. The thing that's been super exciting about this law change over earlier year, bringing it from 1 million to 5 million, is that it's also now excited a lot of the larger players to participate in this and actually carve out what we call at WeFunder a community round. Because at the end of the day, what you're doing is you're involving your community of unaccredited investors to be able to jump in, be a part of the rocket ship pre-IPO, and become your ambassadors, which is exactly what Paul was alluding to earlier. And another standpoint, when you're dealing with or talking to VCs, or like, maybe you're in between a seed round and an A round or an A to a B round, well, what you're essentially doing by allowing them to jump in on a single line on the cap table. So, to your point, Larry, you're not going to have your grandmother and your mother and, your neighbor and your best friend's cousin on there. It's going to be all rolled up to a single line on the cap table, the lead investor that you allocate, through the SPV. And at the end of the day, what you're doing essentially is like reducing your CAC to a negative, and you're like increasing your LTV beyond the charts. And so if you were to go to your next round and go raise your next round, you're like, yeah, check it out. I've got this A+ VC. I've got these great angels, but I also have, 20,000 individual ambassadors, for my product. That's absolutely huge. And we're seeing that. We even had Mercury Bank, you might know them. It's a bank for startups. They raised 110 from Andreessen Horowitz, but they carved out 5 million for their community so they could bring them along for the ride. And since you can also raise these once a year, absolutely, we're seeing companies fit this into their strategic roadmap.
Is there, Ben, I'm assuming what Paul has said and what you're saying, is there a quintessential company that's fit for crowdfunding? In other words, one of the early takes on this was, hey, this might be good for company that's customer facing or individual facing. But what if my company is making some sort of newfangled precision bearing for a nuclear power plant, that no person is ever going to buy? Am I a good candidate for a crowdfunding? Sorry, Gary. I didn't mean to mention nuclear power. But.
That's okay. Wonder where that came from.
Yeah. Truth be told, yes. Look, you can raise 100 grand. I'm going to use WeFunder as an example. That's what I know best, right? But you can raise 100 grand on WeFunder all the way up to 5 million very easily. We can go up to 75 million if we change what the form is. But at the end of the day, just because we're talking about the $5 million sweet spot isn't because you can do that or not. It's because we're incredibly excited as how the law is just getting more and more advanced and, allowing for more opportunity for participation. But we've had a lot of success with B2B companies raising on the platform. And we obviously continue to have a lot of success with B2C companies only because they have the audience already, right? They're already marketing to a mass audience. But even yesterday, I was on the phone with a company that was figuring out how to bring commercial testing of batteries, specifically for EV vehicles or EVs, down from 8 hours to 30 seconds of 5 minutes. These guys are clearly an R&D company that are doing a whole bunch of stuff with the scientific community, the National Science Foundation and whatnot. And, they're going to be raising on us as well, at least a $500,000 round to help boost things, for what they're doing to get them on traditional grants and whatnot. So look, at the end of the day, for $100, per person, you can really have people altruistically believe in what you are doing and want to be a part of it. And that's really exciting for people, because in today's age, like, people are more altruistic than they were, and they just want to feel like they belong and are a part of something. And this is a way that they can do that. And yeah, it's definitely not, limited to B2C companies whatsoever. We've seen successes in all of them. And at the end of the day, all these platforms also bring their own investor community. I mean, WeFunder has over 1 million investors that, once you launch and everything else, we can put your company in front of to help raise. Some companies choose not to do that. Mercury Bank was one of those. They raised $5 million just from their dedicated community. We didn't even open it up to WeFunder audience. But a lot of companies will rely on that, where we help them with that. They'll get their friends and family in, they'll get their angels in or whatnot, and then we open it up to the broader community to top it off.
Terrific. See if I can get the slides to advance here. There we go. So maybe now this slide is a little bit older. I know it's before the the recent changes that bumped up the size, but maybe you could help us sort of put what's happening in the crowdfunding space since the rules were adopted, as up to date as you can get us would be terrific.
Yeah, totally. I mean, I guess what this slide says on a very macro perspective is that there's a lot of opportunities here, for you to be able to find the right home for your company and what makes the most sense. We started in 2012. Like, our CEO, Nick, was really instrumental in working with the SEC, on the ground floor, trying to get everything pushed across the line. I mean, we were in business for 6 years before we could even really do anything, and then continuing to push that forward. So, at the end of the day, you're seeing that everybody's growing. There's a considerable market cap. There's a lot of people going to different things. We focus specifically in Reg CF. Others also kind of dabble into like real estate or NFTs or whatnot. But this year, we're going to close the year with about 200 million in raise on our platform, and that's not slowing down. I mean, that's a significant bump from 2020, and we're really excited about that. I mean, it's democratizing capitalism in a way, and it's really exciting for us to be a part of it.
That's terrific. Let's see if we can jump up here too.
Yeah. So
unless I passed over one of the
that's
slides.
okay. I can talk about that geographic slide really quick, because I think this is really important to note here. I'm in Massachusetts, and I'm a little upset that Massachusetts is on this thing. But no, we're actually seeing raises all across the country. I mean, we even have market reps in all these different states, and it's been really exciting. In fact, our company takes an Amtrak train trip all across the country to go and just engage with founders in different markets. I mean, not all innovation takes place in the top 12 markets, right? And so that's another thing that's very exciting about, basically Reg CF, is that, we're allowed to sort of help influence Main Street and also, Silicon Valley, Silicon Prairie, Empire, whatever you want to call it, right? So that's been the really most exciting bit, is because, maybe you're a startup that's raising a venture capital round, or you're going through angels and everything else. Great. We can flesh that out with a community round. Or maybe you're a coffee shop that wants to open up a second location, and you want to do a rev share or a debt note or something like that. We can do that too. And that's what's been really exciting, is because it's all across the country. We're really helping people participate that are unaccredited from the ground up. And that is really, really rewarding and hyper exciting. And we are expanding into the EU, but you are allowed to accept investments from people globally. So even if you have to be a US based company, but maybe a US based company that has a lot, big social following, or you have a lot of people in South America that are excited for what you're doing, or in Europe or anywhere, they can participate. And that's, again, really, really exciting. And going back to, one of Paul's mentioned, one of the topics that he mentioned earlier with the testing the waters thing, this wasn't around when Gary raised with us, and you'll hear from Gary shortly, but the testing the is huge, because you could actually launch a campaign on WeFunder within 15 minutes and you can start raising, basically getting, promissory notes and commitments from your community so you can test the waters, immediately as you continue to build, pull together resources. You only need to file the Form C once you get to 50,000, and we do that for you. So ultimately, you can just get going. And that's been really exciting because it's reduced the friction to start, see if you have something that's going on, and then plow onto the sunset. Because at the end of the day, every founder knows this, raising capital is like a full-time job. Investor relations is a full-time job. And it's cumbersome because, your job is to grow your business. And if you're focusing a ton of time on over here, then the metrics start to hurt over here. And then, the investors are like, well, why are your metrics hurting over here? And you're like, well, because I'm over here, So anything that we can do to sort of streamline that process, get you to test the waters as quickly as possible, get you to get it to your community is awesome. And we all want our friends and family to participate, but they can't typically unless they're writing you the first check pre-seed. This is a vehicle for you to be able to do that. And public solicitation of it is also loosened up quite a bit, which is exciting because back in my day, I couldn't do that whatsoever. And, one of my last companies had over 12,000 1099 contractors. We would have been highly successful having a resource like this. So, it's just exciting. And let's move on to the next slide. But, happy to talk about it further because it's exciting.
Terrific. I know this is what everybody's here today to hear about, how to have a successful raise. And I'm delighted to get your thoughts. We've talked about a few of these points already. Feel free to, from your perspective, any of them that you want to talk about. One that I'm particularly interested is, and it's been alluded to a little bit, but there's the bullet point, the third point on day one money, having commitments lined up from the start. What does that mean to the folks that are listening? They're like, I want to raise money. I don't have money.
Great question. I mean, honestly, what that is that, instead of opening up and getting a check from an angel here, a check from a friends and family here, a check from this and this here, and all of a sudden you already have 6 or 7 people on the cap, it's actually just to create, do the testing the waters and get a few people to commit directly to that immediately. They're already rolling up to an SPV. You could incentivize any of them to, be the lead investor on that, which gives them additional, eyeballs and credibility and whatnot. There's no fees above a check of $25K. So, even if an angel's like, yeah, I don't want to do that, but I don't want to do it through a platform because of whatever, there's actually no limitation there. Yeah, that has a huge, impact, especially before you sort of turn it to the public because, the public's the public. They want to see traction, right? And so a lot of things that do influence a successful raise is when we go public, not having it be $0 in there, right? And so you really want to try to sort of, juice that a little bit. Sometimes in the test in the water space, you're not even public yet with it. You're just literally circulating it in your private community and your friends, family, angels and whatnot. Just get it up there and you're building the page, you're getting feedback. And then once it reaches a certain point, boom, then it's public, then it goes.
Create a little FOMO, right? We only have this much,
yeah.
and we
That's
have,
right.
it's already, people have already taken it.
That's exactly right. I mean, there are sort of levels that you can set where it's like, there's this much in the round left, hurry up type thing. And yeah, I mean, I've been a victim of FOMO myself on our own platform where I've just like forgotten to do something. And I'm like, I missed out, because you feel like you're a part of it. And it's very much exciting. I mean, obviously other things to lead to a successful raise are, being in good company, obviously having a good product, having a great solid founding team that has some historical track record. Potentially being a part of any other group or accelerator like a Y Combinator, 500 Startups, Techstars, Mass Challenge, anything like that. Maybe working with some other government groups, grants, programs, things like that, having a unique technology, having an audience. I mean, all these things, there's no one perfect formula, but you really have to look into that like what's going to incite someone to want to actually get aboard for this for a long time. Because when people are putting an investment in, like you guys said earlier, they're not putting it in and then they're going to trade it that next year. They're putting it in for the long haul. And a lot of these people they're not investing at this stage. They're not investing necessarily in the company. They're investing in the future vision and the founders. So really, I stress to a lot of our startups, just put a video up there of you chatting about what you're doing and why you're doing it and what's compelling you to do it, because that's what people buy into these days at this point, at this stage.
And I'm sure, Ben, being on the right portal is absolutely critical. I know if you could take off your WeFunder hat for a second, what should people think about when they're choosing a portal, or what's your pitch when people come to you and they're thinking about different portals?
Yeah, that's a really good question, and thank you for doing that. And yeah, I'm happy to take it off. Listen, I've only been at WeFunder for 4 weeks and 3 days, or today's Thursday, 4 weeks and 4 days. I sold my last company in August. I took a little bit of time off. My wife and I have a kid coming in April. Like, there's a lot of things that kind of, and I was trying to figure out, am I going to start another company? Am I going to do this, that, and the other? And I ended up at WeFunder just because of their altruistic vision and their movement and what they're doing, and their hyper focus on sort of fixing capitalism, if you will, in Reg CF space. A lot of the other platforms out there, yeah, sure, if you get into the details, they might be a little bit more expensive. They might need, be whatever, but they're also focused in a lot of different areas. What I really liked about WeFunder and why I chose to ultimately join was because, Nick, our CEO, has been in the trenches since 2012. He helped write the laws, write the space, figure it out. And they're hyper focused on product. I mean, we went from, 10 employees at the beginning of this year, I think, to now we're at about 100, mainly because of these changes and everything. But all the other companies are raising hundreds of $1 million and doing all these things. And we raised $5 million off our own platform just to keep, we don't need, we're just hyper lean, mean, and founder first, and focused on the product and really kind of this altruistic mission. And so, yeah, that's why I joined this one specifically and didn't even consider the others. They're just, yeah. This is We Are Y Combinator. The other guys are Mr. Wonderful. And
love it. I love it. Mr. Wonderful might not like it, but I love it. Paul, talking about some success stories, obviously just a drop in the bucket of data points here. Is there a theme that we're trying to convey to the audience that sort of ties together everything that we've talked about already?
Yeah, I would say there's a couple of themes. One of them is the geographic theme that been talked about, where these raises are not limited to Silicon Valley, New York, and Boston. Anyone can have a good idea, and now anyone can get exposure. And the traditional sort of what you would think of as a founder, I think, is vastly changing. Crowdfund Capital Advisors, which curates equity crowdfunding data, has a lot of information on the sort of the changing face of the demographic face of the founder, the changing geographic face of the founder. So these were just, Neighborhood Son you'll hear about in a second, but these were just a few of them that I just pulled off of Crowdfund Insider, and you can see that even if you can have something really innovative, you can be not a traditional, what's thought of as a traditional founder, and you will have a much better chance to raise this way than you had in the past.
Yeah, and we'll turn it over to Gary in a second, although Gary is somewhat in the sweet spot of what you might have thought is the customer facing crowdfunding opportunity. Some of these others aren't internal combustion engines, cancer detection. Those are not things that somebody's going to be, bragging to their bowling league that they are a user of that product, right? I mean, those aren't sort of they're not your B2C type things, at least in the traditional sense. Which brings us really the best for last here. Gary will talk about Neighborhood Son and their transaction. We at Next and Paul at the Crowdfunding Lawyers were very happy to work with Gary on his successful raise on the WeFunder platform. So I'll turn it over to you, Gary.
Yeah, thanks, Larry. And I absolutely loved working with Next and with Paul. You guys made it so easy for us. And of course, WeFunder was the platform we chose. We, as you can see, I've got my team behind me. We recently expanded into New York by acquiring Astral Power. We've had phenomenal growth. We started out as just a Maryland company, and we had angel investors. So we had about 25 angels from within the DC, Maryland, Virginia area. But as we were looking for our future growth, we were looking at what's the best way to do it. And we chose to do crowdfunding for a few reasons. One is it fits our brand, as Larry kind of said. We're in the sweet spot, but more importantly for us, we are about democratizing energy. And we love the fact that that crowdfunding democratizes investments. So it's a very natural fit for us. We want to be a people-powered business, so to speak, and we would much rather have individual investors than be beholden to a large bank or predatory VC, although there are good ones out there as well. I think it's friendlier for entrepreneurs. As a longtime entrepreneur, I could tell you having the small investors versus some of the more, I would say, higher maintenance large investors. The small investors give you the chance to succeed without constantly looking over your shoulder, questioning your every move. It really puts the decision making in your hands as the entrepreneur. We did have an existing customer base, and that was important for us because when we did the raise, we didn't have the testing the water provision, which sort of changes this. But we were, one of the concerns is how do we get the word out to people that you should invest in us? And we already had a base of several thousand customers that we could let know about the raise. Having said that, only about 15% of our investors are actually customers. So we ended up, it was a nice kind of little safety blanket, like, okay, we got our customers, they're going to invest. But ultimately, we actually got investors from all 50 states in the country and even a few international. It's also part of our branding strategy. So we wanted to expand into other markets. And so what better way than to have a few people who are already investors from some of these other markets like New York or Massachusetts, California. My recommendation for all of you on the call is to research the platforms. We did our research. We looked at about 4 of them and we chose WeFunder. The pricing was very good on WeFunder, and we also like the fact that they are more socially conscious. I guess I'm getting the move on.
No. Sorry. I opened the chat box. Somebody had a question, and I inadvertently touched my screen, Gary.
Okay. But yeah, for us, WeFunder is a socially conscious platform, and we are a B corporation, so that was important for us. We recommend you talk to your stakeholders. So make sure everybody's on board with this. We were able to convince everybody, and everyone, of course, at first was a little worried, but after they saw what we did, they're all thrilled. Ensure you have a campaign in place. I'll talk a little bit about that on the next slide. And I do highly recommend utilizing legal help. The Form C by itself can be a little daunting, but we use Paul, not to blow up his ego too much, but it was so easy working with him to get the Form C, because it is a little scary as an entrepreneur. I mean, this is a document that is going to the SEC, and I don't want someone knocking on my door in the middle of the night saying I filed something wrong. So definitely utilize legal help.
So,
right.
So Gary, when you're going into different states, are you talking to investors that are looking at different states to expand? Are you talking to investors that have already invested with you in those states?
We are. Well, we're letting people know that we're coming into these states for sure, and asking them to kind of be our brand ambassadors to kick things off. Yeah. So this is a partial screenshot from our fundraising page. And I want to point out that the first thing is the video. So as Ben mentioned, the video is, I believe, one of the most important things. We did it on an iPhone. We edited in a little bit. We had some video footage from a drone over a project, but it was very easy to do. And the most important part about the video was hearing from myself and a couple of the other team members about our vision for the company and why we think it's so important. The rest of the investment page is, some of it is the legal stuff, the Form C, et cetera. Some of it is endorsements from your customers saying how much they love you. There's several actual different pieces to it, but in my view, as a longtime marketing person, if you capture people with the excitement of the video, they're much more likely to invest. And you see on the right, we invested, we got over $1 million. It actually says that you invested 280 because I just, to test it out, I put a couple dollars in as well. So I have skin in the game. We did take a long time. We did this for over a year. When I first started, I thought we would be very happy to raise $100,000. I was just looking for some bridge money until our next round. But it just kept coming and snowballing and snowballing. We started doing Facebook and digital ads and got a great return on our investment there. And we said, let's keep it going. And we kept it going until we got to $1 million. And that was fantastic because it gives us the leverage now. If we are going to a Series A coming up very soon, but it gives us more leverage to talk to the VCs or other institutional investors because we have some money in the bank and we have already proven that we can raise money.
Terrific. Thanks very much, Gary. And we'll save some time for questions here. We'll put in a little plug for ourselves and Paul. I think I referred to you as the crowdfunding lawyers. It's the Jossie firm. The crowdfundinglawyers.com is Paul's website. And as Gary mentioned, the legal team is very important. The things we can help you do is evaluate the instrument, make sure it's appropriate, help you pick the right platform. No offense to Ben, because he's usually got his hat on. And when you talk to Ben, he's going to tell you about the benefits of the WeFunder page. And that may be the best platform for you, but there are other platforms out there. Your lawyers, as Paul mentioned, there are some, and Gary called it the legal stuff. Paul and I call that what we do for a living, but there are some very detailed disclosures you have to put together to describe your financial statements, to describe your companies. And although crowdfunding has only been around for a short period of time, information disclosures to investors has been around for 80 years. And there are, experienced lawyers that can help you understand and put in context and minimize the exposure to yourself and to your companies. The SEC is now very interested in crowdfunding. They took their first enforcement action this fall against both a crowdfunding company, and maybe Ben will wish he knew this before he joined WeFunder, but also against the portal where the crowdfunding took place. And this may be a nice segue to one of our questions. The company in question was 420 Real Estate. You may guess what that company did. They were in the cannabis space in some way, so they may have had multiple targets on their back. But we've as counsel, we come across a number of issues that it's very important for companies to understand. One of them are the disclosures. We've come across companies after the fact when they didn't use counsel, and they're trying to then sell the company, and you go to look at the instrument that they use, and Gary's got over 1,000 investors. We've had a situation where somebody comes to us and they say, we've got 1,000 investors, ranging from $100 to $250, and they have some provision in their instrument that needs to be amended in order to do the transaction that they want to do. There's no way to contact 1,000 people. Some of that is solved with, Paul talked about the SPV rules. There are certain types of transactions we've also come across where once you've got 1,000 equity holders, it may have implications for the type of exit you want to do. In particular, if you want to do a stock deal with another private company, a private company may not be able to issue shares to your 1,000 investors. So it's important to know those sorts of things up front. And Gary mentioned the things that they're doing to or have done to promote their offering communications outside the portal. Those are subject to regulatory requirements. Also, FINRA took an action against not the issuer, but against one of the portals this summer for communications outside of the portal that didn't quite sync up with the communications that were going on inside the portal. As you could imagine, it's pretty important to you spend a lot of time with your lawyers in the portal to craft a story that complies with all the legal requirements, that you're then not on YouTube putting out a different hyperinflated story. So that's what those folks got in trouble for. I mentioned the cannabis company that got in trouble. Paul, or Ben, I don't know if you know the answer to this. One of the questions that came in from the audience here was whether crowdfunding can be done in the cannabis space. I think the answer to that is yes, although there are some portals that won't take cannabis companies. But I don't know if Paul or Ben, you have a different or complementary view on that.
Yeah, from our perspective, we have a bank that we obviously that we bank with and everything else, and so there's this sort of dual partnership of what we're allowed to do. We are not allowed to work with companies that grow or sell it and operate in that space. We're allowed to work with companies that are doing hemp, CBD materials, utilizing hemp, things like that, R&D software platforms powering the industry. But we're not allowed to do actual sort of retail marijuana.
Right. I think that's similar to if you look at the public markets, NASDAQ also, what we think of as a rule of thumb, the company can't be plant touching. But
actually, I like that. I'm going to steal that from you if you don't mind. Plant touching.
And that kind of goes to a larger issue, Larry, that these portals have the ability to sort of be selective in who they take. They are not obligated to take anyone. And so that sort of may play into the calculus of which portals you go for, or do you have a second choice? And also, what I think is going to be, WeFunder is a absolutely great platform. It's a big general platform, but in the future you may see some more specializations towards specific industries, where you have a core of investors that particularly like those, and a core of startups that want to interact with them.
Terrific. One of the other questions, there you go, Ben's answering it in the chat, is what are the costs to raise money? Ben, you want to say what you said in the chat there?
Yeah, sure. Yeah, 100%. And jump in as well, from the next perspective. But from what I've seen historically, it's been our raises are traditionally 6.5% to 7.5% in terms of what we take. We don't take anything off of $25,000 checks and above. So any angel investors, VCs, we've had people throw in $1 million, no big deal. But then depending on how much you raise triggers how much scrutiny we need in terms of your books and accounting and everything else in that capacity. And then of course, legal work, which is hyper important, by the way, coming from a founder's perspective. Oh my God. It's more headache to not have an attorney than it is to have one. Those costs can range anywhere between $10,000 to $25,000, But again, if you're raising $5 million, having certified audits and all this other jazz that costs maybe 25 grand or so, it's drop in the bucket.
That's helpful, Ben, and that's sort of right. We work closely with Paul, and we have a fixed price package that we offer to people for the crowdfunding work that's on the lowest end of that range that you've quoted. Sometimes about half of the companies that come to us, they might come to us as an LLC, so you need to convert them to a corporation depending on what they're doing. They might come to us and they say, well, we've really got these 4 entities, and we're like, okay, that are equally owned. Okay, well, you got to really restructure yourselves and put it all together. So there might be legal housekeeping, that companies need to do. That's not part of that, but the crowdfunding itself, I think that's right in the ballpark, and that's sort of what we hear from the marketplace also.
100%. And it's worth handling that stuff early and right at the beginning. Crowdfunding aside, just general advice is, handle any of that housekeeping before you really start raising significant capital and start going to things, because it just makes things a lot easier, especially if you have friends and family in the business with you or doing something. And it depends on how you started the business, but yeah, that's really important.
And then I see I'm just gonna sort of pick off the questions that people have posted in the Q&A here, and I'll keep going until we have time. Paul, there's a question about how do you structure the SPV? I mean, I think most of the SPV generally is a vehicle that the WeFunder or the portal sets up. It's important to understand it, but it's not really something that gets heavily negotiated. The portals like to have their SPV. They're the ones sort of selling out of that vehicle.
Right, and there are other dynamics with that, with the lead investor part of it that Ben mentioned early. So there are parts of this where the legal will sort of really dig in their teeth, and there are other parts where it's just going to be more of a review and constant updating of any questions about it. And so the SPV, the advantage is you get that one line on the cap table. But that, there's been a lot of upfront legal work done for that in the period of time when this was being considered by the SEC. The portals really got on top of that and said, how can we make this the best situation for the founders?
Great. Now, an anonymous, who I think is not the political author, asked about how much can be raised. Paul and Ben, I think you said $5 million. That's on a rolling 12-month period. So after your 12 months is over, you can do start a new 5 if you wanted to.
Or you can do, $250,000, shut it down, and within that 12-month period, you're still just on the aggregate 5 million. So you could potentially do multiple raises in 1 year. There's accounting scrutiny that you have to deal with, depending on what your metrics are. But the 5 million is an aggregate per 12 months.
Right. Now, there's a Frederick asked a question about investments from other countries. Now, Ben, I know you said, you can take it from anywhere. I think what I've told people is, we have to make sure, if you're taking money from somebody in Italy, that it works under Italian law. The crowdfunding platform, sort of the legality of that ends, at the 2 mile mark offshore or wherever our extraterritorial reach is for that purpose. But you have to make sure that whatever you're doing, whether it's, Italy or Japan or wherever, that it works there also.
Mm-hmm. Yeah, correct. 100%. I mean, and I think also that's part of the platform's responsibility, right? I mean, that's not where, we're not just sitting here and like taking the capital, sitting on it, distributing it. We're actually facilitating a lot of that back end legal work and the setup and everything else. And we're expanding into the EU like crazy anyway. But even if you're like setting up a note that's like a rev share, profit sharing agreement, debt to whatever, we're also facilitating all of the administrative stuff in the back end, and so that's been good for us in terms of that capacity of opening it up to a greater audience of investors.
All right, that's terrific. I think we end at 3, and we're just at 3. There's lots of questions here still. So, if you've got a question that you'd like to have answered, feel free to. Gary's running a company, but me and Paul are dealing with companies that are and Ben that are want to do crowdfunding. So feel free to reach out to us or to Ben. And I'll thank everybody for joining us today. It was a terrific presentation. Paul, Ben, and Gary, I know you've all got busy schedules, so thank you for joining us. Absolutely wonderful presentation.
Larry, I think the email is on that last slide if you want to just give them a quick look at that.
Okay, terrific.
Yeah, I was going to say I encourage anybody to reach out just to chat with me with any questions specifically related to that. And when it gets into some legal stuff, I'll push them directly to the guys over here at Next, because I am 100% not a lawyer whatsoever. But I am a founder, and I love talking to fellow founders and helping them figure out the next steps.
If I can go to the last slide, info@next.law. If you've got questions and they come in today, we'll get them to me and Paul, and we're happy to get back to you.
Thanks everybody for watching.
Yeah, thank you, folks.
Take care all.
Thanks everyone. Keep going.
Yeah.
Keep building.